everyone. Welcome back to another episode of our Clear Path video series. This week, I'm joined by our Chief Investment Officer, Daniel Westergaard, who is going to share a research piece that came out last week on dividends.
Thanks, Jack. Yeah, excited to walk everyone through this piece today. A primer is that dividends are a crucially important piece of being equity investors. But before we talk through this piece and specifically what this relates to, I want Jack to explain to us what dividends are so that we're all on the same page.
Thanks, Daniel. So we wanted to just make sure we define our terms with an illustrative example before we go through this research piece. So in this illustrative example, let's assume a company sells $100 of their product. Let's also assume that it costs that company a total of $90 to make and sell that product. Again, this is overly simplified, but this helps to illustrate the point. If that was the case, they sold $100 of their product, and it cost them $90 to do so, that leaves $10 of profit or earnings for that company. So if that was the case, that company would have a couple decisions on their hands on what to do with that $10 of profit. Here are three different things that companies in the real world do with their earnings. The first thing that they can do is they can reinvest that money back into the business. An example of a company doing that is Tesla. So usually this is earlier growth stage companies that are growing very quickly, where the best use of those earnings is to plow that right back into their business to grow more over time. Another option they have is that they can go to the open market and actually buy shares of their company's stock on the open market. All else equal, over time, by doing that, they should increase the share price of the company, which in effect puts money back in shareholders' pockets. An example of a company that's done this very aggressively over the past decade is Apple. And so that's another option that a company has. The last thing they can do with that profit is they can pay a dividend. So this is another way of returning money straight back into shareholders' pockets. And a company that's done this for a very, very long time is Walmart. So all that being said, hopefully that helps better illustrate what we're talking about when we refer to the term dividends.
Great explanation, Jack. As Jack pointed out, dividends are simply the cash flow that companies pay out to shareholders. These dividends make up a large portion of total return for the S&P 500 over the last 80 plus years. Dividends have made up over 34% of this total return. That's an important part and why it's critical to own stocks throughout an investor's portfolio. So as you can see, as we move to the chart that's now on the screen, dividends have outpaced inflation on a year-over-year basis for the last 45 years. So looking back to 1979 through 2023, the dividends per share paid from the S&P 500, which is the largest companies in the US, have grown at an average rate of 5.78% per year on average. For comparison, the Consumer Price Index, or our best measure of inflation, grew at just over 3% per year over this same time period. So said differently, the dividend growth rate has outpaced inflation by over 2.5% per year on average for the last 45 years. Our goal as investors and on behalf of all of our clients is to help maintain purchasing power. What we're trying to do is make sure that your money grows enough to outpace inflation. This is why owning equities that pay dividends is crucially important in this mission.
Awesome. Thanks, Daniel. So clearly, dividends are an extremely important piece of our overall return as investors. This specific data point I actually was not familiar with until First Trust released this last week. So we found it really helpful and wanted to share. And is there anything else that is worth passing along, Daniel?
Yeah, one final note that I'll leave you with, again from First Trust, is that S&P 500 companies are currently paying record high dividend payments, but they're paying out a smaller portion of their total earnings in dividends than they have in the past, which for us as investors, this is great news because it means that these companies are potentially more likely to increase or at least keep dividend distributions steady as earnings keep going up. Bloomberg is forecasting that the S&P 500 will see earnings growth of nearly 9% and 14% respectively in 2024 and 2025. As always, we don't know what the future will hold, but this is helpful perspective in staying the course and maintaining stocks in a well-diversified portfolio.
Awesome. Thanks, Daniel. So if you have any questions as it relates to this video or your personal situation, we'd of course be happy to talk about that. reach out to us and we can get a meeting set today. Thank you. Bye-bye.